Hi, everyone. Thank you for joining Wisdom Tree's office hours on Fed Watch. Will it be a cruel summer for the markets? Where you will hear from Professor Jeremy Siegel, Wisdom Tree senior economist, Jeremy Schwartz, our global chief investment officer, and Kevin Flanagan, our head of fixed income strategy.
Professor Kevin, it is always great being on these post-Fed, post-inflation type of calls with y'all. Get your latest takes. We called this one with another Taylor Swift reference. Will be a cruel summer. And Taylor just did her Eras tour. It seems like the era of the Fed is changing, Professor.
Yeah.
As part of this tour, we're gonna get your take on what does the new era look like? When do they start cutting rates? And what you heard from the Fed today. It's a new era to begin.
Sure. Happy to. Okay, so when the statement came out, I was frankly disappointed. And but the conference was much more dovish than the statement in terms of the way he framed it. I was actually surprised that he said there was quite a lot of discussion about a rate cut today. Now, I knew there won't be. The one you could say good or bad thing about Powell is that he has to telegraph everything. So he's not going to surprise the market unless it's absolutely necessary. So there was going to be no surprise. But the fact that there was a contingent that thought there was a rate cut means that next meeting there will be a cut, barring some very unforeseen, and there always could be unforeseen. Now, I mean, we have oil up today. We know about the heating up of the Israeli-Hamas situation. Could that bring about an all-out war? Now, if there does an all-out war and oil goes to 90 or 100 or whatever, what might that do in terms of maybe forestalling a cut? There's all sorts of things. That's why nothing's 100%. But there's, barring anything, critical like that, it's definitely on the table. I was a little disappointed that, there was a question from the group, the audience, the reporters, what about 50 basis points? Is that possible? He said, no, he sort of said that wasn't on the table. I thought it was wrong for him to foreclose it. It should be on the table, even if it's not at all the mean expectation of what is happening. I think what was also very encouraging was he really did stress the duality of the mandate. In fact, in my opinion, for the first time in, probably since the pandemic, he put employment almost above inflation as a concern. In fact, he said there's no one number. In other words, I think what he was saying is even if the number on inflation for July, which is coming out, in August, is not the greatest, I'm looking at the totality of the market, and in other words, at the labor market. It will be very interesting what happens tomorrow on Friday. On 2 days on Friday. If we have a negative shock like zero growth and unemployment ticks up again to 4.2, the whole discussion will be the Fed is behind the curve. And the discussion will be not a Fed single rate cut in September, but a single or double rate cut in September. That he should, in fact, enact. I mean, the inflation trends are extremely good on the commodity markets, on all the other markets. And basically, he also pointed out that the slowdown in inflation that we've seen in the second quarter is much better founded than the slowdown in inflation that we saw in the second half of 2023, which was a question from the reporters. That was also extremely encouraging in terms of what direction. So the only problem I see is if it's called for, and I'm not saying I see it, a recession or a big drop off, could he move fast enough? Is he willing to move fast enough? Because this idea that I have to telegraph, I have to tee it up, I have to then go a quarter, that's not the way the world really works. The world changes often much more quickly, and you have to respond more quickly in that case. So the danger would be if things slow down. And again, I mean, we did see okay growth second quarter. Remember, that's April, May, June. We're already, August next tomorrow. So, I mean, people look at last, 4 months ago and say, oh, the economy was decent then. Right. But the rise in unemployment claims and the softening of the labor market has mostly come since then. So it is something that we definitely should be looking at going forward. What happened to the market? I mean, the market sort of was flat during the statement period, and when he started talking and being dovish, it kept on going to new all-time highs. Now, I do see it kind of sold off at the end, as well as the bond yield, which has really, the 4.05. Could that break below the 4 handle? Yes, with a weak jobs report on Friday, it really could break a 4 handle. And that would start a buzz also in the market. We saw a big bounce back on growth, particularly NVIDIA, which, of course, went way down, now way up. So we sort of reversed the sort of value growth. I have pointed out many times that what we saw over the last 2.5 weeks in growth was an undoing of the previous 4 weeks of an upsurge, and we're back to the trend line. And how it reacts to that trend line, I think, is really going to be key in terms of, whether we really have a small value cap advantage. And if he lowers rates and does so in timely ways, there's no reason to believe that in fact, will not be the case. But overall, I thought the news conference was more realistic than the very cautious statement that he made. Don't forget, the next meeting will be a dot plot where the year end of 2024 will be given. So we will know what their forecasts are, not only for September, but also November and December, and how many think there's going to be more cuts on how many more cuts. In some ways, the September meeting is the most informative of all meetings, because it gives you a time frame in the future that's actually more knowable and actionable than the 2-3 years where they have really no idea what's going to happen in that distant future. So that becomes a very, very important meeting for us. And of course, it will be dictated by the pace of the inflation and the employment report.
So, Professor, I think that's a great segue, the September meeting coming up, but could we have a quote unquote unofficial Fed press conference at Jackson Hole towards the end of August?
Yeah, good for bringing that up, Kevin. Yes. So what, and we will, and because of Powell's strong inclinations not to surprise, I don't know the date of that meeting exactly. It's usually third week, maybe fourth week. That's close enough. September 12th is the meeting, if I'm correct, where if he sees it at that time, that will be he will indicate that it's time to ease monetary policy or not, but probably time to ease monetary policy. Yes, I think you're right, Kevin. I actually think that the Jackson Hole meeting is going to be a de facto press conference of great importance in terms of what he sees forward.
Professor, when we came into this year, they expected a lot of cuts. Now they're coming closer to 3. As you think forward to next year, how are you thinking about the path for where they should get to, where they think they're going to get to? Sort of that commentary on the path cycle here.
Sure. Well, first of all, you're perfectly right, Jeremy. So the December Fed funds is with the January Fed funds actually, which will reflect the December meeting, pure meeting. The December Fed funds is a mixture of the two. So I take the January Fed funds is at 458 right now. Wow. So 458 is exactly 75 basis points under the current 5.33% Fed funds. That's, of course, exactly 3 cuts. Now, remember what I always say. There is a hedge built in there, probably a half a cut hedge at this point. Usually a year hence, I call it 125 basis point cut. Probably now 6 months, we're talking about half. So there's probably 2.5, between 2 and 3 Fed cuts that are now built into that. So it's a little bit more than September, December, as far as that's concerned. The June Fed funds for next year, which is July, reflecting the June meeting, is at 422. So that's another 25 basis points. If I had to guess, I'd take the under on that, because very honestly, the neutral rate is somewhere around 3.5, and I would hope by then we would be so much more close to the neutral than that, and he would feel that he could perhaps lower 50 basis points to get down to that rate. If I were to do that, I'd take an under.
I'm going to go with the 800-pound gorilla in the room. And he got asked the question. I think I know what your answer is going to be, Professor, but the election. What, if kind of impact do you think it will have on the Fed this year? Which is interesting because the November Fed meeting, they actually pushed back a day, actually comes out after Election Day. So your thoughts on that?
Right. So he was very explicit in the press conference that he will do and they will do what they think is best for the economy and take no mind of the election. I do think the election has now become close enough that it actually adds a lot of uncertainty in October and November to the risk markets, actually, more than before, when you kind of said, oh, yeah, Trump, I know what, all right, that's what's going to happen. But if, given the election, he has actually said that he will keep Powell through February 2016 when his term ends, 2026, I mean. And if he's not elected, he doesn't have that choice. And I don't see any reason why Harris would not also keep him and perhaps even reappoint him if he so desires at that particular juncture, 2016. But very honestly, I believe that they will just do what's right. I mean, they don't need those political jobs. Those political jobs that all those bank presidents, Fed governors, and Jay Powell have is way below their alternative pay. It's not like now there is a power for to be Fed chairman, but it's certainly not a matter of, wow, they could go into the private sector and make 10 times what they're making. So, there's no reason for them to call it like a good public servant should, in a way that would be good for the U.S. economy.
When you think about the impact of the rates and what sectors, sort of there was one question was of should we be cutting if inflation is so much higher? I know you have a view that inflation is so much lower, but housing comes into question a lot on the impact of rate cuts. Any comments on sort of residential real estate, what you think
Right.
from rate cuts?
I hear the housing market is definitely softening. And of course, with the case shower, as well as the Federal Housing Finance Association, which just came out Tuesday, being 2.5 months behind, you're not seeing that talk. But you talk to realtors on both the rental side and on the pricing side. It's a different world from where it was a year ago. Now, it's not a terrible world either, but stuff is sitting on the market. There's price cuts. I see it. There's concessions. There's mortgage buy downs. This is a change. I think you're really seeing it on the ground now in the housing market.
So another question just came in, and you just touched on it. If you could just repeat your thoughts on the neutral rate and how is that calculated?
Right. Okay. So the neutral Fed funds rate, which is sometimes called R star, the natural rate, is what after inflation rate of interest on the short term keeps the economy in balance, supply and demand. Now, to get how you translate that to a Fed funds rate, you add the target inflation rate, which is 2, to R star. So 2% plus R star is the long run Fed funds rate. Now, in the last, it comes out in the dot plot that is put out every quarter. So it will also come out on September 12th. The last meeting, it was raised 1/10 to 0.8%, which means if you add the 2, you get a long-run Fed funds of 2.8. Well, we're nearly double that now. Now, I have lectured for quite a few months that I think it's even higher than that. I think it's somewhere, between 1.5. Maybe even a little higher. I mean, if you say 1.5 and you add the 2% inflation rate, then you get a long-run Fed funds of 3.5. And we're 2 percentage points nearly above that rate. So there's 200 basis points of restrictive Fed funds rate. In other words, rates above R star, rates above the natural rate, rates above the equilibrium rate, that add to restrictiveness onto aggregate demand in the economy.
Maybe tying this to equities, we did get a question both submitted just now and before. Like in response, you've done a lot of work on history. When you think about the reaction to Fed cuts, how do you think about the market valuation today and how it would look to these
Well,
cuts?
we still have bifurcated. I mean, despite the fact that tech's come down, there's still a very wide wedge between the valuation ratios, the PE ratios on value and growth. I mean, you still have what growth, 25, 26, you have Mag 7 at 30 plus, well, above that, which is almost 30% of the S&P. And then you have the value stocks at 17 and the small stocks. So if you take the median of the profitable small stocks, I don't know what is it, 12, 13, really low. So it's almost like what segment of the market do you want? Very honestly, I think there's a lot of uncertainty second half of this year. Political uncertainty. And I say that because with this, if Harris should pull this out, it is not at all unlikely that the Senate and the House will also be Democratic. In that case, corporate taxes are going up, no question. And that has an effect on earnings in 2020. Maybe it wouldn't be an effect of 2025, but 2026 because all the tax cuts expire. So it becomes very meaningful. This election is really meaningful for the tax situation and the fiscal situation going forward, like some that not many that I've seen in the past. And because of the closeness of the House and the Senate, you could have all three branches of the government Democratic, and you could have all three of the branches Republican, which would be a totally different framework. And we may not know until the night of November 5th, and we might not know that night either. But that's uncertainty, and the market usually discounts uncertainty. I mean, doesn't like it. I'm not saying I see a correction coming, but I would honestly be very surprised to see the market in the second half of the year as strong as what we saw in the first half of this year.
I mean, one of the strategies we've been talking about in fixed income is doing the barbell, using our Treasury floating rate note, USFR, combining it with our yield enhanced AGGY, AGGY, or our new 7 to 10 year laddered USIN. So we get a lot of questions. Where do you think the yield curve is going from here?
Well, I think it's normalizing eventually. I think the long rate is in the zone. I said 4 to 5. Now it's very close to the lower end. And I think Fed funds should be 3 to 4 in that case, which would give you a normal slope of the Fed funds of the term structure curve of 100 basis points positive. Now, I might reassess that as time goes on. I mean, maybe the fact that it's 4.04 right now on the 10-year means that they do see some weakness coming up in the economy. I mean, we're going to get productivity in the second quarter next week. It's going to be better than the first week, but the average for the first half of this year is only 1%. Long run average productivity growth is 2%. So, first quarter was dismal. So we were hiring workers, but the productivity wasn't there. Now there's a question of whether AI is going to really bring that productivity back into 2025, 26, 27. How is that going to affect the real growth rate? Of course, there's a positive relationship between that real rate, especially long-term, and the GDP growth in the economy.
Related to that 10-year number, the 4% type yields and the risk to them, there's a question that came in about asking to go a little bit more into your views on why you're not worried about the national debt level and what that might be on rates. I'm
not worried about the national debt level because for several reasons. First, 30% of debt's held outside the United States, and when you look at debt to GDP ratios, you're looking on U.S. GDP, while it's held worldwide. And so the world GDP is the more important. We're nowhere near the highs on U.S. debt to world GDP as we were formally. Second reason that I'm not concerned is that really the amount that's being added to the debt is not inabsorbable at the current rate. $1.5 trillion a year is just satisfies the need for U.S. government debt around the world. Where we really kink upward is the mid-2030s, which is a considerable way out. Third, that even though debt to GDP ratios look like they're threatening their 1945 post-World War II highs, debt to wealth levels, and that's really important, how much government debt you have, whether it's stocks, bonds, real estate, and everything else, is nowhere near that high. In fact, even in the 50s and 60s, we had far more government debt relative to the wealth of U.S. alone consumers than we have today. I just don't see the debt as a near-term problem.
So, Professor, I heard a little bit of cautiousness in your remarks there. So I get to hear the professor's comments every week, and so hearing that the second half of the year is not going to be as good as the first half. It's been an amazing first half. So that
it still could be good. Well, the question is, if you'd ask me a harder question, is it zero? Is it 0 or 5%? Because then you're challenging, fixed income, in a real way, on that. And, listen, with the standard error, as we all know, of short term, it's a fool's errand to try to predict, a 6-month horizon on what's going to happen to stock prices. I just do see some threats ahead with a full valuation going forward. And maybe we could have, in fact, now, if you ask me the question, Jeremy, do I think value in small in the second half is going to exceed value in small in the first half? I would say yes. But I don't think growth could do that.
Well, that's great. A number of questions came in on small caps in particular. People are trying to figure out if this extension will continue, where to be focused on that. We talk a lot about small caps and sort of quality approaches in small caps to manage through some of the interest rate risk, but you've certainly been having a junk rally off of small caps. People with the most debt are getting excited about the lowering of yields, but
don't forget when you have a stock that's having a loss, the equity is almost an option. I mean, you add or out of the money option, and if there's any hope that goes in the money, you have 20-30% gains, as with an option. So, I mean, I'm not surprised that with that, rate now look like it's going down, people are saying, hey, I'm taking the option value of that. And listen, this is what we've been saying a long time. You have these, these low PE situations. They really do give you leverage when the rate goes down, and in more ways than one. Not just in terms of a portfolio leverage, but also in terms of an operating leverage. Because as we have pointed out, their interest expense is much more on the short side than it is for the large stocks.
So final question from me. I'm sorry, Jer. I was going to say, final question from me. It's been kind of a hot button issue for fixed income. Private credit. Do you have any thoughts on private credit?
I'm not an expert on it. I don't have thoughts. I mean, very honestly, I see private credit as going with the business cycle. In terms of, if you have a recession, it won't do well because there's more risk. Now, whether there's a margin enough in there built in to offset it in the long run, maybe yes. I mean, I said that, I've held the Vanguard high yield junk bond fund for 45 years and have had a really good return. Not as good as stocks, but much better than any other bond portfolio. So, with private credit, same question we could ask of private equity. Now we're talking about people putting private equity in ETFs. That'll be interesting. We see Pershing pulling its IPO. Interesting. All those are new choices for the investor.
And me for a closing thought on equities, somebody wrote in about international and EM. We've talked a lot about small and value. A lot of times international is like a value tilt versus the U.S. growth stocks. But as you think about the election, maybe any color on what?
Well, I've taken the point the last few months that we're going to see a tendency towards dollar weakness, mostly because I do think if I had to take the over under, I'd take the under on where the market is predicting the Fed is going to move, and that would move the dollar in that way. So that would be good for foreign stocks and good for EM. And EM is also good because they do have dollar debt. And to the extent that that debt can be turned over at a lower rate, that's very favorable to them.
Very good. Well, Professor, it's always great to get your comments on what you see from the Fed. For people who want to follow along, we do offer model portfolios for advisors here that we can service you all. Look at sort of our path, our website for model portfolios to find out more about the Professor Siegel-oriented model portfolios. And again, thank you all for tuning in. Professor, always great to talk to you. And Kevin, great to have you on too.
Yeah, have a good weekend, guys. Bye.
Thank you.